Okay, folks, we are going to be covering some major market analysis concepts and techniques, and I believe this should be the origin of any effective top-down analysis. And what we're going to be basically introducing is the concept of intermarket analysis. Now, since I've been active on the internet, sharing insights and concepts that I've personally traded with for over 16 years now, I get asked a lot basically what was the major milestones or concepts that I learned that really made a dramatic impact on my technical analysis as a trader. And the one I go to first and foremost, and is the single most influential concept, was the one of intermarket analysis. Now, intermarket analysis is a branch of technical analysis that examines the correlations between four major asset classes, those being stocks, bonds, commodities, and currencies. In his classic book on intermarket analysis, John J. Murphy, he notes that traders can use these relationships to identify the stage of business cycle and improve their forecasting abilities. There are clear relationships between stocks and bonds to commodities and commodities and the US dollar. And by knowing these relationships and correlations, these can help the chartist or technical traders like we as forex traders to determine the stage of the investing cycle. Intermarket analysis turned my once mediocre technical analysis into consistently informed trading, enabling me to see the big picture and not simply the price action of whatever particular asset I was trading at the time. All right, the market in fourths. We've already mentioned briefly that there's four major market asset classes that go along with major market analysis. Those four groups being domestic and foreign bond and or interest rates. And simply because I base a lot of my trading on the US dollar and the US Treasury market, we're going to be referring to the 30-year Treasuries, the 10-year Treasuries, 2 and 5-year Treasuries, etc. Obviously, it's not limited to just this. There will be discussion on foreign bond and interest rate asset classes that we'll cover later on in the series that we're sharing now. But moving on, the second asset class is the stock and or equities markets. That would be the Dow stocks, the S&P 500 stocks, the NASDAQ stocks, etc. Commodities and futures. And whenever we're referring to commodities, we always want to first look at the CRB index, which is basically the barometer for commodities as a whole. If the CRB index is trending up, that is by and large the indication that you should be looking for buy signals in the commodity markets. And obviously, conversely, if the CRB index is trending lower, you want to be looking for sell signals in the futures and commodities markets. The commodity markets are broken into basically the agricultural and financial, and I'm not going to refer to the debt instruments because we already mentioned that in the A section. Obviously, the last and most important to us as forex traders is the currency asset class, and that's broken into the US dollar as the benchmark to weigh all other currencies. And one could still argue about that considering the strength that it is right now, but that's not what the topic's going to be for this moment. But the US dollar and the foreign currencies is the fourth and last asset class that we have to contend with when we do major market analysis. All right, when we look at all these four asset groups, okay, there's two environments that we have to work within, and that is an inflationary environment and a deflationary environment. The intermarket relationships depend on the forces of inflation and or deflation. In a normal inflationary environment, stocks and bonds are positively correlated. That means they're going to trend together. If the bond market trades up, the stock market will be trading up in sympathy with it. The market, if it trades lower in the bond market, stocks will trade lower. If the bond market trades higher, stocks will trade higher. So they're positively correlated. Now this means they both move in the same direction, obviously, but the world was in an inflationary environment from the 1970s to the late 1990s. And these key intermarket relationships are found in an inflationary environment. A positive relationship or correlation between bonds and stocks. An inverse relationship between interest rates and stocks. Bonds usually change direction ahead of stocks. An inverse relationship between commodities and bonds. a positive relationship or correlation between commodities and interest rates, a positive relationship or correlation between stocks and commodities. Commodities usually change directions after stocks, and an inverse relationship or correlation between the US dollar and commodities. In an inflationary environment, stocks react positively to a falling interest rate, which basically translates in our technical charts as rising bond prices. So the bond market will be rallying on your chart for this instance. Now, low interest rates stimulate economic activity and boost corporate profits. As interest rates fall and the economy strengthens, demand for commodities increases and commodity prices rise. Now, keep in mind that an inflationary environment does not always mean runaway inflation. It just simply means that inflationary forces are stronger than the deflationary forces. Okay, so what does that look like and translate into a chart? Well, what we're looking at here, the higher chart on the upper half of this depiction is the 30-year Treasury bond, and the lower portion is the S&P 500 cash index. You can see during an inflationary periods that the bond market and stocks rally together until we get to the late part of 1998 in the fall, where there was a major decoupling between stocks and bonds, and we entered into a deflationary period. We can still see that stocks rallied, but the bond market was now trending lower. So there was an inversion. The secondary environment we have to contend with as traders is the deflationary environment. Now, obviously, deflationary forces change the whole dynamic. Deflation is negative for stocks and commodities, but positive for bonds. A rise in bond prices and fall in interest rates increases the deflationary threat, and this puts downward pressure on stocks. Conversely, a decline in bond prices and rise in interest rates decreases the deflationary threat, and this is a positive for stocks. The list below summarizes the key intermarket relationships during deflationary environments. There is an inverse correlation or relationship between bonds and stocks. One will go up while the other goes down. There's a positive relationship between interest rates and stocks. There's an inverse relationship or correlation between commodities and bonds. A positive relationship or correlation between commodities and interest rates. A positive correlation or relationship between stocks and commodities, and an inverse relationship between US dollar and commodities. While the dollar and currency markets are part of the intermarket analysis, the dollar is a bit of a wild card. As far as stocks are concerned, a weak dollar is not bearish unless accompanied by a serious advance in commodity prices. Now, obviously, a big advance in commodities would be a bearish for bonds, but by extension, a weak dollar is also generally bearish for bonds. A weak dollar acts an economic stimulus by making U.S. exports more competitive. So what are the effects of a rising dollar? Well, a country's currency is a reflection of its economy and its national balance sheet. Countries with strong economies and strong balance sheets have stronger currencies. Countries with weak economies and big debt burdens are subject to weaker currencies. A rising dollar puts downward pressure on commodity prices because many commodities are priced in dollars, such as oil, for example. Bonds benefit from a decline in commodity prices because this reduces inflationary pressures. Stocks can also benefit from a decline in commodity prices because this reduces the cost for raw materials. We can see the inverse relationship between the US dollar and the commodity market viewed by the CRB index. Note that there is a negative correlation or an inversion between the two. When the green line, which is the US dollar, if it rallies up, typically what you'll see, commodities, they'll trade lower. At some point, there will be a transfer and shift in the marketplace. And just like I teach with the correlation study between the fiber and cable in Forex that you've learned so far on babypips.com, this also takes place in the dollar and CRB index. When one makes higher highs and the other fails to make lower lows, that is an indication that there's a major shift underway. And we have to be mindful of that. And you can see that take place in 2002. Note that the dollar was making higher highs, but the CRB index was failing to make lower lows. That is a major market divergence. When you see these events take place in correlated or inversely correlated market indices, it is a tip-off that there is a shift on a major macro level, that there's something happening. We don't need to know exactly what it is, and we may be, gleaning insight from, market reports and fundamental data if you're really into that. But what we're sharing in this presentation is about the extent I go with fundamental analysis. But I look at the large macro view, and by doing that, the tide on the major market level, and then we can get ourselves poised to trade within that trend or flow. Okay, here's the relationship between the S&P and bond market. And during the inflationary period, obviously we've already learned that bonds and stocks will move together. And then there was a decoupling that took place, and there was an inversion where stocks continued to rally while the interest rate market started to trade off into 2000. And then we had another coupling between the two in 2003, a little bit, and then obviously S&P, the stock market, continued to trade up higher into 2007 fall, and then we've basically traded down, and then we went into a higher interest rate, lower stock environment as well. Okay, we can see the US dollar index with the CRB index. You can see now clearly when the dollar surges, the CRB or commodities plunge. And beginning of this year, 2011, at the time of this presentation, we saw that the dollar was slipping lower, which was a catalyst for precipitous price advances in the commodity market, which was also a reason why, if you've been following my thread on babypips.com, I hinted at one of the mega trades that typically happen. There's a few of them that happen every year, but we called the major rally in the Swiss franc based on this analysis here. The dollar was poised to go lower, and the CRB index was really poised to trade higher. Everything was in sync for foreign currencies to move up, and the Swiss franc had everything in its favor to be going higher. And if you look at your charts for the year of 2011, the Swiss franc was an outstanding performer on the upside, and all that analysis was shared on the thread with the open interest factors that we talked about and techniques. And you can see how all that was really hinging on this analysis concept that you're learning here. The macroeconomic view, the long-term macro view, long-term analysis trading down into a more intermediate term top-down analysis that we'll learn more about in subsequent presentations. Okay, this is a standard business cycle. Okay, and the chart is actually being shown in a sine wave chart, and basically it's a cycle that shifts in and out in the marketplace. And the business cycle shown here is depicted by the first three stages are part of an economic contraction, which is weakening and bottoming and then strengthening. Then stage 3 shows the economy in a contractions phase with strengthening after a bottom, and then a sine wave crosses the center line. In other words, we get halfway through the chart. This depicts the economy moving from contraction to the three phases of economic expansion, which is referred to as strengthening, and the market will top off and then start to weaken. And then stage 6 of the business cycle shows an economy in an expansion phase but weakening after a market top. More specifically, let's go through each stage. Stage 1 shows the economy contracting and bonds turning up as interest rates begin to decline. Economic weakness favors loose monetary policy and the lowering of interest rates, which is bullish for bonds. Stage 2 marks a bottom in the economy and the stock market. Even though economic conditions have stopped deteriorating, the economy is still not in an expansion stage or actually growing. However, stocks anticipate an expansion phase by bottoming before the contraction period ends. Stage 3 shows a vast improvement in economic conditions as the business cycle prepares to move into an expansion phase. Stocks have been rising. Commodities now anticipate an expansion phase by turning up. Stage 4 of the business cycle marks a period of full expansion. Both stocks and commodities are rising, but bonds turn lower because the expansion increases the inflationary pressures. Interest rates start moving higher to combat inflationary pressures. Moving on to stage 5, this marks a peak in economic growth in the stock market. Even though the expansion continues, the economy grows at a slower pace because rising interest rates and rising commodity prices take their toll. Stocks anticipate a contraction phase by peaking before the expansion actually ends. Commodities remain strong and peak after stocks. Stage 6 marks a deterioration in the economy as the business cycle prepares to move from expansion phase to contraction phase. Stocks have already been moving lower and commodities now turn lower in anticipation of decreased demand for deteriorating economy. Now keep in mind, this is the ideal business cycle in an inflationary environment. Stocks and bonds advance together in stage 2 and 3. Similarly, both decline in stages 5 and 6. This would not be the case in a deflationary environment when bonds and stocks move in opposite directions. So what's the point in all this, right? Well, technicians and those who trade on technical analysis rely on price charts to give them directional probabilities for their trade decisions. However, good the trader's technicals may be, it never hurts to understand monetary policy, macroeconomics, and the general market tone. Your best periods of trading, be it stocks, futures, bonds, and even, yes, Forex, will come when you are in sync with the macroeconomic environment and your strong technical analysis. You will have a double-edged sword. The highest probable fundamental trends with the highest probable technical trends make ridiculous returns for the savvy trader. Learn to buy high risk asset class vehicles such as stocks, commodities, and foreign currencies when risk is on and the US dollar is weak. Conversely, short high risk asset class vehicles when the US dollar is strong. By doing this, you step the odds up considerably in your favor as a trader. And isn't that what this is really about? Trading with high odds of success? Some closing points to consider. Folks, I know this is very dry information. Now, however, it's very useful insight into long-term success. It's not always just about entry and exit point tactics. We want to be trading with the major market tide on our side, and this is the first step to grasping that understanding on how precisely we do that. Intermarket analysis is a valuable tool for long-term and medium-term analysis. While these intermarket relationships generally work over longer periods of time, they are subject to drawdowns or periods when the relationships do not work. Big events such as Euro crisis and the US financial crisis can throw a certain relationship out of whack for a few months. Furthermore, the tools shown in this presentation should be used in conjunction with other technical analysis techniques. It should be a part of a basket of broad market study designed to assess the overall strength or weakness of the market. One indicator or one relationship should not be used on its own to make a sweeping assessment of market conditions. We must be aware of the whole market to be better informed as traders. If you want to learn more about this topic, and if you have more questions, the two most important books, in my opinion, are by John J. Murphy, Intermarket Analysis, Profiting from Global Market Relationships, and his book, The Visual Investor, How to Spot Market Trends. If you don't have these books in your library, I suggest you get it, and you're going to glean some really good insight and much more greater detail than I can go through with this presentation. My highest recommendation for both of these books. Folks, if you like what you saw here, you can join me on babypips.com. I am the Inner Circle Trader, otherwise known as ICT, on baby pips. And you can learn more pro trader tactics on our baby pip thread and threads that are coming out in 2012. And with that, guys, I wish you good luck and good trading.